Welcome to Law of Consumer Credit Agreements. Okay, so this is a specialized type of contract again, just like a sale agreement. So I'm sure by now you now know the difference between a sale and a credit agreement. So you find that sales take different forms. You have sales for cash and sales for credit, and credit agreements in most cases give rise to sales for credit. So in this lecture, we are going to be looking at the relevance of credit agreements. We'll look at why the new Credit Act was needed. We'll also look at the objectives of the Act, application of the Act, and we'll also look at the types of consumer credit institutions and the credit industry regulation. In respect of the relevance of credit agreements, a consumer credit agreement is a particular type of contract and is therefore governed by general principles of the law of contract. National Credit Act has had an impact on contracts that are consumer credit agreements. So we have the Consumer Protection Act, which does not apply to consumer credit agreements that are governed by the National Credit Act, but does afford some protection to the consumer of credit concerning the goods and services purchased on credit. So what we are basically saying here is that even though the National Credit Act, even though the Consumer Protection Act does not apply to credit agreements, when someone purchases, regardless of whether they've purchased using the National Credit Act, cash or credit, they are still entitled to protection of the Consumer Protection Act in respect of the quality of the goods and services that are purchased on credit. So where no legislation governs a particular credit agreement, the general principles of the law of contract will apply. In the past, consumer credit legislation consisted mainly of the Usury Act and the exemption notices issued in terms of the Usury Act and Credit Agreements Act. So it became clear that a dysfunctional credit market existed that was characterized by discrimination, lack of transparency, limited competition, high cost of credit, limited consumer protection, and an exploitative micro-lending economy. So this was basically during the pre-democracy era, where legislation could also be discriminatory in nature. So you find that the credit market itself was discriminatory, in particular against blacks, and also there was a lack of transparency in relation to certain transactions, and there was limited competition. So in respect of discrimination, you'll find that some of the discrimination is still persisting today, whereby you find that in certain banks or certain corporations may charge higher interest rates as compared to black people, to African people, as compared to their white counterparts. So that itself has been considered to be a form of discrimination, right? So this was quite prevalent during the pre-democracy era. Then we also had an exploitative micro-lending economy. So micro-lending economy is the economy that basically focuses on giving what we call small loans to people. So you may find that if you sit on TV for an hour or two, you're likely to come across an advertisement that says, do you need a small fast loan, and you can just take a short left and get the loan without any security and so on. So those are basically considered to be micro lenders. Right, so micro lenders were exploitative and largely unregulated. An example of micro lenders that we have are known as the machonistas. So machonistas basically operate as if there is no law that regulates them. So that is why they ended up exploitative in. So the previous legislative regime was criticized for being fragmented and outdated, ineffective consumer protection, particularly in respect of low-income groups. Then there was high cost of credit or lack of access to credit itself. Then there was also high levels of indebtedness and reckless behavior by credit lenders and the exploitation of consumers by micro-lenders, intermediaries, and debt collectors. So basically, reckless behavior by credit lenders essentially means that if somebody is overly indebted and you give them a credit, you are considered to have engaged in reckless lending because you have extended a line of credit to somebody who is not likely to pay. So this is normally done by unscrupulous credit lenders who may want to make a profit from interest rates. So they enter into a deal that this particular person will only be paying the interest until they are eventually able to pay the full amount. So you may find that the company may be profit sharing from the interest only. So that's the behavior of reckless credit lenders, right? So that behavior is also exploitative. So they'll be giving credit to people who actually do not qualify for credit, and the intermediaries and debt collectors would also be charging very high collection rates and so on, and that would be considered to be exploiting the consumers themselves, right? So the mechanisms that were put in place were not sufficient to provide debt relief to over-indebted consumers. So a complete overhaul of credit legislation was needed, and this resulted in the repeal of the Usury Act and the Credit Agreements Act, and they were replaced by the National Credit Act 34 of 2005. So the National Credit Act established the National Credit Regulator and the National Consumer Tribunal. So the National Credit Regulator is the body that is responsible for regulating the conduct of all credit providers, and the Consumer Tribunal is the body that is responsible for adjudicating disputes between credit lenders and consumers of credit. So the Act seeks to regulate the credit industry and promote and protect the economic welfare of South Africans, and to promote a fair, transparent, competitive, efficient, and accessible credit market for all. It also aims to prohibit unfair credit and credit marketing practices and protect consumers of credit. Also to encourage responsible borrowing, avoid over-indebtedness and reckless lending, and provide for a system of debt restructuring, enforcement, and judgment. So you have to understand the difference between a credit provider and a consumer. So a credit provider is a person who supplies goods or services under either a discount transaction, incidental credit agreement, or an installment agreement. And a consumer is a person to whom goods or services are sold under a discount transaction, incidental agreement, or installment agreement. A person who advances money or credit under a pawn transaction is also considered to be a credit provider, and the person to whom money is paid or credit granted under a pawn transaction is the credit consumer. And the person who extends credit under a credit facility is a credit provider, and a person to whom credit is advanced under a credit facility is also a consumer. So a credit facility basically includes your credit cards and so on, right? So those are credit facilities. Then we also have the mortgagee under a mortgage agreement. So a mortgagee is a person who may have provided a mortgage bond to a mortgager, right? So what that means is that the mortgagee is the credit provider and the mortgager is the debtor who becomes the consumer of that particular credit. So the lender, where one is a lender under a secured loan, they are a credit provider because they've provided money regardless of the fact that it is secured. They are a credit provider. And if you borrow money, regardless of whether you've borrowed a secured loan or not, you are still a borrower, and that makes you a consumer. Then the lessor under a lease of movable goods is also a credit provider, and the lessee under a lease of movable goods is a consumer. Then the party to whom an assurance or promise is made under a credit agreement, for example, surety, is a credit provider, and the guarantor or under a credit agreement or under a surety agreement is a consumer. And the party who advances money or credit to another under any other credit agreement is a credit provider, and the party to whom money is advanced is or credited under any credit agreement is a credit consumer. So the Act generally applies to all credit agreements between parties dealing at arm's length within South Africa, right? It will not apply to transactions that are not deemed to be at arm's length, right? That is where the parties are too close or dependent on one another. So what that means is that if you borrow from a friend, or if you borrow from your wife or from your parents, you are not deemed to be at arm's length. Therefore, the Act will basically not apply. So if you are at arm's length, the Act will apply. If you're not at arm's length, the Act will not apply. So examples of parties not dealing at arm's length in terms of the Act are where a company makes a loan to one of its shareholders, the Act will not apply. Where a spouse makes a loan to his or her house, the Act will not apply. And where a brother makes a loan to his sister, the Act will not apply. And the National Credit Act even applies to credit agreements where the credit provider is an organ of the state or an entity controlled by an organ of state, an entity created in terms of any public regulation, or the land bank. The circumstances where the other circumstances where the Act does not apply where the consumer of credit is the state or an organ of state, and where the credit provider is the Reserve Bank, and where the credit provider is located outside of South Africa, and his or her exemption is approved by the Minister of Trade and Industry. The Act applies mainly in situations where the consumer of credit agreement is a natural person. The Act has limited application where the consumer is a company, a close corporation, a partnership, or a trust. Certain parts of the Act apply where the consumer is a juristic person, right? The Act provides limited protection to small and medium juristic persons whose asset and annual turnover is below 1 million, who enter into small and intermediate agreements. So the best manner in which to determine if the Act applies to a credit agreement is to always answer the following questions first. Right? Is it a credit agreement as defined in the National Credit Act? Right? Does it relate to a credit agreement that was concluded between parties dealing at arm's length? Was the credit agreement concluded in South Africa, or does it have an effect in South Africa? Right? Are there any of the exemptions as set out in the National Credit Act that apply to the agreement? And an agreement is generally a credit agreement if two elements are present, and these are: there is some deferral of payment or prepayment of money, and there is a fee, charge, or interest imposed with respect to a deferred payment, or a discount is given when prepayments are made. And The Act specifically provides that credit agreements include the following. The first would be a credit facility, the second, credit transaction, third is a credit guarantee, and third is any combination of the So what is a credit facility? A credit facility is an allowance granted by a credit provider to enable a person to purchase without having cash on hand, right? So for example, a credit card, clothing store card, overdraft facility on a check or a current account, on a check or current account. And what is a credit transaction? Credit transactions take various forms. The first is a pawn transaction, a discount transaction, an installment agreement, an incidental credit agreement, a mortgage agreement, a secured loan, a lease of movable property, and any other agreement other than a credit facility or credit guarantee in terms of which credit is granted and the fee, charge, or interest is payable. And what is a credit guarantee? A credit guarantee is an agreement that an agreement constitutes a credit guarantee if, in terms of that agreement, a person who's a surety undertakes towards a credit provider to satisfy on demand any financial obligation of another, the person to whom the money was actually given, should this consumer fail to honor his or her obligation in terms of a credit facility or a credit transaction. So what we are basically saying here is that the person that borrows will have to look for another person who will provide a guarantee that if the principal debtor fail to pay, then the surety will pay for that particular person or on behalf of that person. So an example would be of a surety agreement where a person signs a document guaranteeing a credit provider that he or she will pay if the person to whom the credit provider has lent the money does not repay the amount. The types of credit agreements that the Act applies to would be any combination of the ones that I've just mentioned, including an installment sale of goods in respect of which payments are made by means of a credit card over a period of time. Then what would not be considered to be a credit agreement in terms of the Act? So we have specific transactions and agreements that are excluded from the scope of the Act and are not considered to be credit agreements. They include, number one, a policy of insurance, a lease of movable property, and a stock fuel transaction. Those are not credit agreements. Right? In addition to the above circumstances, the Act also expressly provides that in two specific instances, the transaction will not constitute a credit agreement and therefore the National Credit Act will not apply. The first instance is where a person sells any goods or services and accepts as full payment, A, a check or similar instrument upon which payment is subsequently refused or dishonored. Number two, a charge by or on behalf of the buyer against a credit facility and the credit provider subsequently refuses that charge. And the second instance is in terms of Section 4(6) of the National Credit Act. If a consumer pays fully or partially for goods or services through a charge against a credit facility, and if an agreement provides that a supplier of a utility agrees to defer payment by the consumer until the supplier has provided a periodic statement of account and will not impose any charge of interest in respect of any amount so deferred unless the consumer fails to pay the full amount due. So this basically means that if you receive a bill every month from ESCOM or from eThekwini Water or from eThekwini Water, the National Credit Act will not apply in respect of that particular debt, right? Then We have different categories of credit agreements. We have small credit agreements that include all pawn transactions, and we also have credit facilities, credit guarantees, or credit transactions, except for mortgages that are less than 15,000. Then we have intermediate agreements, and these are all credit facilities where the credit limit is above 15,000, and credit guarantees or credit transactions, except pawn transactions or mortgage agreements where the principal debt falls between 15,000 and 200,000. Then we have large debts or large credit agreements, and these are credit guarantees or credit transactions, except pawn transactions where the principal debt falls on or above 250,000, and also all mortgage agreements are considered to be large. Right, and in 2006, the Act established the National Credit Regulator, responsible for regulation of South African industry. The Act also provides for the establishment of a National Consumer Tribunal, an independent body separate from the regulator, responsible for hearing cases against credit providers which have contravened the Act, and which is empowered to issue fines where necessary. Okay, bye.